Hello, welcome to the final video looking at topic 5, sources of finance. This video will now commence where we left off in our previous video, debentures. There's various types of debentures available. The first one is a nominal or vanilla bond. This is a long-term source of finance and is typically issued in blocks of €100 of a nominal value. So i.e. each bond is worth €100. Debentures or bonds usually have a nominal value and a market value. This is similar to our ordinary shares and our preference shares that we spoke about in our previous video. Interest relates to nominal value, not the market value. So, if an individual has a bond, they are entitled to interest on that particular bond. There is a year of redemption specified. So, i.e. in 2025, for example, the bond will be redeemed. Interest is typically on a fixed rate as a percentage of the bond. It may be secured or unsecured, and the debentures of public listed companies are often traded on the stock exchange. The value fluctuates depending on the expected interest rates that the individual will receive. Next we have the deep discount bonds. This is redeemable loan capital that offers interest rates below market value. So it's issued at a lower amount than a nominal value. For example, they might trade at €80 per €100 nominal value to compensate for the low interest rate. The gain is received when the loan is redeemed. It appeals to companies with short-term cash needs, and it can be traded on a capital market. The next form of debenture we have is a convertible debt or bond. This is similar to a normal bond, except the bondholder has the option to receive final payment of principal as shares in the company, and the interest rate tends to be at a lower rate. Now let's take a look at the stock exchange. Here we are going to look at an overview of the stock exchange, the type of securities or shares traded, markets in Ireland, markets in the UK, and the advantages and the disadvantages of the stock exchange. There's two primary stock markets available, the primary market and the secondary market. You should note the difference between the two of these. Companies can raise new capital by selling shares and bonds to investors. When shareholders wish to sell their shares to other investors, they can do so on the stock exchange. The function of the stock exchange is that it makes all relevant information available to the public on a timely basis. It ensures that all investors deal on the same terms and get the same prices. To channel savings into investment, to provide a market for existing shares and debentures, and to act as an indicator of the financial health of the company. To provide safeguards to investors and to advise investors also. There's various types of shares that can be offered on a stock market. Ordinary shares, preference shares, debentures, bonds, and other specific securities. We do have an official listing, which is the main security market, MSM for short. This is for large companies where more information is required and it's a lot more expensive to list on the main market. Companies that we have here in Ireland listed on the main market include Glanbia, Ryanair and CRH. Another market that we have is the Enterprise Securities Market, otherwise known as ESM. This is for smaller growth companies, specifically designed to meet funding requirements of companies at early stages of their development. Companies that we have here in Ireland listed on the ESM include Applegreen and CPL Resources. Companies sometimes start their life off on ESM and then they graduate at a later stage to the main stock securities market. We also have the London Stock Market, the LSE, and this is the official listing or the main market. It's the main market for larger, more established companies, and companies that we would typically know included on the London Stock Exchange include Vodafone, Marks and Spencer's and Barclays. Next we have the alternative investment market, the AIM. This is the market that was established in 1995 for smaller growing companies. A wide range of businesses join AIM in order to seek growth capital. Companies that I'm sure you are familiar with include ASOS, Boohoo and Venture Tree Drinks. All were listed on the alternative investment market. The advantages of listing on a stock market is that you have access to capital markets and large amounts of finance. It really does broaden your investor base. Typically, anyone in the world can buy shares in your particular company. Institutions are more likely to invest in a public listed company, and additional borrowing is possible. It can improve the debt to equity ratio as a result. It's easier for shareholders to sell shares once they have invested. There's higher financial standing as it does come along with greater precision. Easier to acquire other companies, and it can offer own shares as part or full payment. The market price provides a recognised value of shares for sale purposes. So, for example, if the organisation's shares, let's say they have 1,000 shares and they're marketed at €1,000, in order to find what the price or the value of that company would be, you would simply take the number of shares and you'd multiply it by the market price. It can be used as attracting and retaining employees, where shares are used as incentives. So for many of the public listed companies, they provide shares to their employees in order to incentivize them to stay within the organisation. Disadvantages then: flotation costs are high, so again it does come at a cost. Public listed companies are subject to more publicity and attention than private companies. Stronger risk of being taken over, as shares can be purchased more easily. Additional external shareholders may result in a loss of control of the business. Costs involved in reporting and complying with the stock exchange requirements. Smaller firms may be ignored in favour of larger firms, and investors may have short-term investment and make adverse decisions in the long term. That now concludes Topic 5, Sources of Finance. I hope, after the course of these short videos, that you now have a broader understanding of the sources of finance available to the organisation. For the purposes of your exam, I do not suggest that you learn all of the sources of finance. You should, however, be aware of them all. But I would suggest that you learn a handful that will cover you for short term, medium term, and long term. You should also be aware of perhaps 2 sources of finance that an organisation can generate internally. You should look at the sources of finance available in the short, medium, and long term, and pick 2 to 3 to learn for the purposes of the exam. Again, for sources of finance, this particular topic will appear in the multiple choice section, Section A. There will be at least 4 questions there, and it will also appear in Section B, along with another topic in a long question. Should you have any questions, I hope to be available in class on Thursday to address them personally. Alternatively, if you would like to contact me in the meantime, you can email me at katie.scallon@setu.ie. Thank you for listening.